Imagine doubling your net profit in a single year. Now imagine doing that while crossing a huge psychological barrier, 100 billion Turkish lira in assets.
That's unbelievable.
I mean, that is exactly what İş Finansal Kiralama, or İş Leasing, managed to do in 2025. It's just a staggering leap in scale.
It really is. That's one of those years that, defines a company's trajectory. They didn't just grow, they aggressively expanded, and the profit followed.
Welcome. We've got their 2025 annual report and financial statements here, and we're going to figure out how they did it.
Let's do it.
So let's first get to know the company a little, because despite the name, it's not just about leasing, is it?
No, and that's the first big aha moment when you look into them. They're based in Istanbul, a real heavyweight in non-banking finance. But if you look under the hood, it's a dual-engine business.
Okay.
You have your classic financial leasing, so financing heavy equipment, machinery, real estate, that sort of thing. But then you have factoring.
And factoring that's when you're financing receivables, right?
Sure.
Basically buying up other companies' unpaid invoices for quick cash.
Exactly. And here's the real kicker. Factoring generates significantly more revenue for them than the leasing business does.
Wow. Okay.
Yeah, they own about 78% of a subsidiary, İş Faktoring, and that engine is just running red hot.
So the sign on the door says leasing, but the cash register is really ringing for factoring.
In a big way, yes. It gives them this really diversified income stream. And you have to remember, they aren't doing this alone. They're part of the İş Bankası group.
The parent company.
Right. And you see that connection in the governance. The Group A shareholders appoint the board. It's a massive safety net.
Which probably explains their credit rating.
Absolutely. Fitch gives them an AA. That's a very strong competitive position. But like any financial institution, they're extremely sensitive to currency and interest rate swings.
So how do they manage that risk?
Well, they hedge a lot. The report is filled with derivatives, forward contracts, swaps. They're working hard to keep those risks under control.
Okay, that makes sense. Let's unpack the numbers then. Now we can move on to our analysis.
The main headline is just pure velocity. Their main operating income, so total revenue, surged to 16.85 billion TL in 2025.
And what was it in 2024?
It was 11.7 billion, so a huge jump.
And I'm guessing that factoring engine we talked about was doing the heavy lifting?
It sure was. Factoring income hit 11.2 billion TL. Leasing was about half that at 5.65 billion.
And did that translate all the way down to the bottom line? To the profits?
It flowed like a waterfall. Net profit almost doubled. It hit 3.63 billion TL, up from just 1.93 billion the year before.
That's incredible.
And their earnings per share nearly doubled too. It rose to 0.0522 TL.
So let's circle back to that 100 billion lira number I mentioned at the start.
Yeah, the balance sheet. Total assets jumped to 101.2 billion TL. That's up from around 70 billion. They also built up a nice little war chest of liquidity. Cash and equivalents rose to 2.84 billion.
But you can't grow assets by 30 billion lira out of thin air. Someone had to pay for that expansion. Was it all just bank loans?
This is where it gets really interesting. Bank loans did go up to 65.1 billion TL, as you'd expect, but look at the line item for securities issued.
You mean corporate bonds and things like that?
Yes, that number just skyrocketed. It went to 18.3 billion TL. It was only 4.8 billion in 2024.
Whoa. So they basically quadrupled the amount of money they're raising from bonds.
Precisely. It's a strategic shift. They're tapping the capital markets much more aggressively to fund this growth, not just relying on the usual bank credit lines.
That feels like a bold move. But is it a risky one if you leverage up that fast?
Well, their equity to debt ratio is currently at 16%. It's down just a tiny bit from 17% last year. So they still have a cushion, but there's no question they are leveraging up.
Okay, was there anything in the footnotes, in the fine print that might pour some cold water on this?
There are two things you absolutely need to know. First, the cost of all this growth. Non-performing receivables are up. They had to set aside 1.8 billion TL in provisions for expected losses.
Not surprising, but important. And the second thing?
Inflation accounting, or I should say, the lack of it. The report is very clear that TMS 29, that's the standard for inflation accounting, was not applied to these 2025 statements.
Why not?
A regulatory decision by the BDDK. So what we're looking at is nominal growth in a high inflation economy. It definitely changes the lens you view those profit numbers through.
It absolutely does. It's still impressive growth, but that context is key.
Very key.
So, to sum it up, We've got a company hitting 101 billion in assets, doubling its profits to over 3.6 billion, and pivoting hard toward the bond markets to fuel it all.
It's a classic, aggressive expansion play.
Which leaves us with a provocative thought for you to take away. With the company shifting so heavily toward bond issuance for its funding, how will interest rate changes in 2026 impact that 16% equity-to-debt cushion they're sitting on?
Yeah. That is the multi-billion lira question, isn't it?
If you found this breakdown helpful, please do like the video, subscribe to our channel, and share this content.
And we'd kindly encourage you to evaluate channel membership. It really helps support us in making more of these videos for you.
And don't forget, you can always show your support with super thanks. Thanks for listening.